Good afternoon, and thank you for joining our Connections webinar, Foreside Partner Spotlight, Blue Tractor Group, where we will discuss Blue Tractor's novel Shielded Alpha ETF wrapper and how it's ideally suited for active managers looking to accrue the benefits of an ETF while still fully obfuscating the fund's proprietary alpha generation strategy. My name is Beth Kicciati, Associate Director of Marketing, and today on the phone with me I have Joe Higgins, Senior Director, Foreside, and from Blue Tractor, Terry Norman, founder, Simon Goulet, co-founder, and John Mulroy, Capital Markets. We're excited to have these subject matter experts on our panel today. Before we get started, I just want to give a quick introduction of Foreside. So here at Foreside, we pair comprehensive and customized advice with best-in-class technology to help firms in the investment management and broker-dealer space. We help them continue to innovate, improve, and grow. We tap state-of-the-art technology to help firms drive operational efficiency and flourish in today's regulatory environment. With Foreside as a partner, firms can dedicate time and effort to portfolio management, securities transaction and execution, client service, sales, and other value-adding work. And with that, I will turn it over to Joe.
Great. Well, thanks, Beth, and welcome, Blue Tractor. Personally excited about today's call, because at Blue Tractor, at Foreside, we've been early adopters of ETFs. We were one of the first outsourced solutions to ETF issuers. We've known the guys at Blue Tractor for a very long time. And just to give a snapshot, today we partner with nearly 100 ETF issuers and service over 500 ETFs. So we'd like to say that we've really seen it all. We've helped launch probably some of the most innovative products that are in the market today. So when the idea of a new wrapper of the ETF was presented to us, we got excited and intrigued. And Simon, I'm sure you could talk a little bit about that history as well. But we started those conversations early on because what it did, it really married up Foreside's motto, which was being at the forefront of innovation and technology on behalf of our clients. So what is that wrapper? We're talking about the active, non-transparent, and semi-transparent space. And what that does, of course, just to generalize it, it gives managers who weren't otherwise going to offer ETFs now start thinking about offering it because it gives them the ability to not have to disclose their portfolio management and trading strategies, which in essence is really their capital IQ and IP. So we're fortunate. We were one of the first entrants in the space on behalf of our client, American Century, who utilized Presidion's model, and then later utilized New York Stock Exchange's model. And so we're very excited to now talk to Blue Tractor, find out where they are today, do a little deep dive, and hope for some additional launches kind of coming all of our ways. So with that, let's learn a little bit more about Blue Tractor. We'll start with backgrounds. We have Terry, Simon, and John on. I think your guys' backgrounds, they're all unique, and when put together a nice, really packaged firm. Terry, if we could start with you, then Simon and John on your background, and then we can talk a little bit more about Blue Tractor. Terry?
Okay, thanks very much, Joe. We're all glad to be here today. My background's in quantitative model development, where I specialised in generating alpha generation programs, risk control, basket trading systems for asset managers both in the UK and the USA. Just as an aside, the Blue Tractor idea came up when I was actually cutting the fields on my farm, on my tractor, and it's those ideas from that day when I was cutting my fields that today underpin Blue Tractor's novel Shielded Alpha ETF structure that we'll discuss today.
Yeah, hi everybody. This is Simon Goulet, and delighted to be here as well. And Joe, thank you for that warm introduction. I do remember when Terry and myself began this journey about 4 years ago, meeting the Foreside team, Chris Lanza, Dave Whitaker, yourselves, etc., Sonia Formato, and just always feeling like there was a sincere interest in our technology and also our success. So thank you for that. My background is in investment banking, both in Toronto and New York. Met Terry quite a few years ago, and this idea sort of stuck in our heads of how we could solve this so-called holy grail of providing pricing and arbitrage mechanism for a so-called non-transparent ETF, i.e. an ETF that does not disclose the full portfolio every day. How could you solve that problem and provide the market makers with the opacity they want to conduct primary markets efficiently and secondary markets, but also provide the, as you say, the advisors with the assurance that their IP, their secret sauce, so to speak, is hidden, and that's what we've done with Blue Tractor. John?
Yes, Joe. My background is from the trading floor of the American Stock Exchange, where spiders were the first ETF back in 1993. Previous to that, I was an options floor trader, so I've been kind of on the ET part of the equation for many, many years. And then I moved over to the capital markets side, which I ran at Guggenheim for about 12 years or so. And then hooked up with Blue Tractor because I like what they were doing, and I think my skill set on the ET side of the equation will help them move forward. And that's it.
That's great. And for those of you listening who don't know John in the ETF space, that's okay, because he knows everybody you know. And I've learned that as well. And I always learn a little, every time I talk to John, I always learn a little bit more about the history of certain aspects of the ETFs, and so they're fortunate to have you. So I'm glad you're on. So if okay with you guys, the way I'd love to structure this, Carl, is in a few different pillars. We'll talk a little bit about the background of Blue Tractor, just a little bit more, Terry. An update on the space would be great, and then a dive into really the Shielded Alpha structure, just getting into the nuts and bolts there. Role of capital markets, I think that's a valuable discussion. Insight on distribution, always valuable. And then what it looks like to engage Blue Tractor from a fee perspective. I'm sure you guys get that question a lot. And then lastly, what it all means for the RIA community and the end investor. With that, Terry, you talked on your intro, you talked a little bit about how you formed the firm, and Simon, you touched on what problem you're trying to solve for. But just to give me that NPR, how I built this moment, what were you looking to solve for? What gave you the idea to want to build Blue Tractor as a company and really take this entrepreneurial approach?
Well, as I say, it went back to late 2014 when I was riding my tractor. It just so happened that I'd read a recent SEC report that morning discussing some of the issues surrounding certain structures and their failings in trying to bring a non-transparent ETF to market. And a number of those issues, one in particular was arbitrage. How do you arbitrage when you can't see what's in front of you, i.e. within the creation unit? So there was that issue, and everyone at that point in time was really crying out for transparency, and I felt that we were fighting against the tide by going a non-transparent route. That wasn't what people wanted in those days, maybe not today even. They wanted transparency. They wanted to see their holdings at the very least. So that combination, along with that paper I read, enabled me to start thinking of ideas to overcome these issues. And as I say, that was the genesis of the Blue Tractor wrapper. There are other wrappers out there. There are other solutions out there. And in fact, there's quite a large number of names all purporting to offer different wrappers. But there are only 3 wrappers out there. And the way you actually look as to what name fits into which wrapper is by looking at the creation unit. And the creation unit is key to an ETF. Many things. It's key to the in-kind creation redemption process, cost reduction and tax efficiency. So, as I say, despite all the names out there, Presidian, T Rowe, NICE, Invesco, La-di-da, Blue Tractor, there are only 3 wrappers, and they can be defined by the creation. And let me explain. And as I explain, I'm going to take a little high-level view from a market maker's perspective as well, how they see the creation unit, because that will affect your client's experience when they come to trade their ETF shares. Now, at one end of the scale, you have preceding and its active shares wrapper, where the creation unit is simply cash. And unfortunately, with this new wrapper comes new layers of administration, an APR, pricing agents. And those guys need paying. There's no free lunch in finance. From a market making perspective, although they get a value every second, they have little idea of the risks that they're exposed to, because all they can see is cash. So there's uncertainty surrounding their risks, and that uncertainty will manifest itself in wider bid-ask spreads, particularly in times of high volatility. Then the second structure is what we term the proxies. And in that group you can put NICE, FIDO, Zero, eventually probably Invesco and Eaton Vance. And here the creation unit contains decoy securities. But what I mean by decoy security is simple. It's a security in the creation unit, but it's not in the underlying portfolio. And some securities that are in the underlying portfolio are actually absent the creation unit. So there's a total mismatch. So when a creation actually occurs, the manager is receiving securities he doesn't actually want, i.e. the decoys. So he has to go to the market, sell them, and then go and purchase the security he's done. And that incurs cost and will detract away from performance. From a market making perspective, the market maker doesn't actually know what risk he's exposed to, because he doesn't know whether he's looking at a decoy or a security in the underlying portfolio. And that uncertainty, once again, will manifest itself in wider bid-ask spreads, and that will once again affect the client experience when they trade the ETF shares. And finally, there's the Blue Tractor creation unit. The Blue Tractor creation unit is unique because it only contains the names of the securities in the underlying portfolios, i.e. no decoys. So during the creation, a manager is receiving only the securities he wants. And from a market making perspective, market makers can see the risks they're exposed to. So it's unique in that it offers transparency where the others do not. And it's best for lowering costs and greater tax efficiency than any of the other wrappers.
Yeah, I like this slide a lot for those that can see it and listening, because, as you know, there are about 5 or 6 that received SEC approval: Fidelity, Presidian, T. Rowe, New York Stock Exchange, Legg Mason, and of course yourselves, and then the Eaton Vance and others are really going through that process as well. But it's almost like there are so many, we need that framework. So this does an excellent job, it seems like, of being able to differentiate each of the aspects. If okay with you, I can turn it over to Simon, because then we can talk about, let's talk about the nuts and bolts here. Let's talk about the Shielded Alpha structure and what that means. I'd love for you to just really dive in.
Yeah, and I will, Joe, but I'm also a bit of a history buff, and I thought maybe some of your listeners may enjoy the fact that, this journey, Terry's being a bit modest, it took us about 4 years to get SEC approval, and frankly, it took some other firms even longer. So as you know, Joe, this has been a long road for this market, the so-called non-transparent market. And, Terry talked about our transparency, and that's true. However, I think for most listeners, we are still lumped into the non-transparent space. It's just simple for the pundits and the media to call us all non-transparent, even though, as Terry ably explained, we're all very different on the transparency spectrum. But, people should know that some firms have been at this since 2012, 2013, so it took a long time. But now, hopefully, I applaud the SEC for the agreement to let us all through the gate, so to speak, in mid and late 2019. Yeah, so let's dive into the Blue Tractor structure in detail, and I have a slide here that kind of gives you a high-level overview. So really, as we've talked about, the whole idea is to cloak the alpha strategy of the manager inside an ETF wrapper. So give the manager the benefits of lower costs, tax efficiency versus a mutual fund, as well as intraday liquidity, but at the same time ensure that your proprietary strategy can't be front-run by predatory third parties. We also have a very simple turnkey workflow that I'll talk about, and the whole idea is to maximize cost efficiency and tax efficiency, because they really are the hallmarks of this wrapper versus the traditional mutual fund or SMA. The workflow uniquely in Blue Tractor is all cloud-based, and I'll talk a bit more about that in another slide. The idea is to balance the opacity versus the transparency. So the opacity the manager wants versus the transparency the market makers and APs need to appropriately hedge their risk and transact efficiently in the primary and secondary markets. Obviously, we want to hide the secret sauce, and that's a term that some folks don't like. I mean, there are some active managers out there that don't feel that transparency is a problem. Think of Kathy Wood and ARC, or Chris Davis at Davis Funds, and I applaud them for embracing transparency and full disclosure of what they're doing. But for the vast majority of active managers, they're not comfortable doing that. They want some sense that they can hide to some degree what they're doing from the market. And we also offer uniquely what we call basket management tools. These are cloud tools that we offer our PMs so that they can go in and tweak and modify the basket. It's not a custom basket, but they can still modify the weightings in the basket to lower transaction trading costs and boost tax efficiency. So let me give you an example for those that really like to geek out. Let's say you are long IBM in your portfolio at 2%, and you wish to increase that to 3%. Well, but you have a choice. You can go in the market yourself and buy IBM shares and incur transaction costs by doing so. Or you can overweight in the Blue Tractor structure in the basket IBM. So you can overweight IBM to 3 or 4% in the basket. Next time there's a creation transaction between an AP and the fund, they will deliver IBM at 4% weighting to you. So therefore, you're receiving those IBM shares for free and helping you rebalance your portfolio up to the 3% where you want to be. So these are the kind of things you can do with the Blue Tractor wrapper that we're very excited about. We also really focus on tax efficiency. That's so paramount for the ETF wrapper versus a mutual fund wrapper. And we allow a manager to turbocharge or really amp up the tax efficiency in our structure by being able to conduct what is called a heartbeat trades. And I won't go into the details here, but it's suffice to say that it's a unique feature of our wrapper that we'd be delighted to tell people about more on a conversation at a later date. Terry also touched upon the fact that our wrapper is very simple and clean and has no requirements for external new layers of complexity like an APR or the VIV. We also have no use of proxy stocks. These are all things that create friction in terms of cost and operational effort. And we don't have those structures, or we don't have those features. So net, simple turnkey workflow designed to cloak your alpha strategy and maximize your tax efficiency and lower your costs. That's the Blue Tractor wrapper.
That's great, and the thing that stuck out, well, a lot of aspects did stick out, but that cloud aspect is unique. I get asked about it. I in turn have to ask you, but can you dive? And we do have a slide, which is great, but can you highlight that a little bit more? I think that would be helpful.
Sure, Joe, and that's really, I think, a real unique differentiator for the Blue Tractor wrapper, the fact that we've embraced the cloud. I mean, let's be honest, it's 2020. People are moving their operational workflow and their data to the cloud in all parts of their life. Why wouldn't we also want your ETF to be in the cloud? When I mean the workflow in the cloud, what I mean is the workflow required to generate the daily basket, okay? And in our wrapper, as a PM active manager, you run your strategy no different than today, you know, what you do today in a mutual fund, no different. But what I mean is that all the workflow to generate the basket is done in the cloud with Blue Tractor. And it's hosted on the Microsoft Azure cloud. We only have data on US hosted servers. Very streamlined, simple workflow. And because it's Microsoft, we can assure you that it's encrypted and secure. So none of your portfolio data can be seen by anybody else. It's also important to point out that with our workflow, only the portfolio manager and the custodial bank are the only ones that see the data of your portfolio. In fact, Blue Tractor does not see your actual portfolio because we make sure that this is all compartmentalized and hived off only for you. And as I mentioned, the other cool thing about our creation basket workflow in the cloud is that we offer tools for the PM to adjust and tweak the basket, as I mentioned, to lower trading costs and enhance tax efficiency. These are really, really unique to Blue Tractor. They're not custom basket features, but they're awfully close. We also have features in the cloud that, in the same vein, that allow you to fully cloak your activity when you enter a new position or exit one. So again, embracing the cloud is 2020. Why wouldn't you want to be in the cloud?
Yeah, and I think that's a nice segue to, because cloaking is what it's all about here. And can you talk a little bit more about how managers just, it's that general question, how can I protect my secret sauce here in my portfolio management IP? And what does that look like with your guys' structure?
Absolutely, Joe. I mean, I think real simply, there's kind of two scenarios that a PM should think about. I mean, you're at rest, you're doing nothing. Your portfolio is just sitting there for a couple of days. It's moving around because of price movements, but you're not being active. So there's that scenario. Then there's the active scenario where you actually want to buy a new position, trade out of one. So we have to address both those with our cloud, with our solution, and we've done so, we think, quite elegantly. As Terry mentioned, the way the basket works with Blue Tractor is this. All the names in your portfolio will be in the Blue Tractor creation unit. However, the weightings between the basket and the weightings of the actual portfolio differ. So for example, as you can see on the slide, if you have Apple in your portfolio at 2% weightings, every day the Blue Tractor algo will generate a new position weightings for Apple. So on day T, it may be at 2.3%. The next day the algo runs, it's at 1.8%, 1.6%, then back to 2.1%. So even though you've done nothing, you have not traded Apple whatsoever, still in your portfolio at 2%, the algo constantly moves that weighting in the basket up and down. So for a third party observing the published basket, they don't know if the movements they see are real portfolio trades or whether they're an artifact of the algo. And this way, the delta between the actual portfolio and the basket weightings perfectly hides the manager's activity. Because again, nobody knows if what they see is real trading or it's just the algo. So that's how it's done in a static situation of no trading. When you want to become active, though, this is when the basket tools that we talked about already allow the manager to go in and adjust the weightings in the creation basket to hide what they're doing. Let's say you want to go and buy Tesla in your portfolio. You buy Tesla today, it appears tomorrow in your basket, okay, because it's T+1 accounting. But what you'll do then is artificially maintain Tesla at a very low weighting, let's say 1 or 2 basis points in your basket. Meanwhile, over the next 3 or 4 days, you fill your Tesla portfolio target weighting, and then you unleash the basket to what it's supposed to be around. So therefore, over those 3 or 4 days, no one knows that you're filling Tesla in your portfolio. Conversely, let's say you wanted to unwind Tesla. You've had a great run. You've made some money. It's time to take some profit off the table. Keep Tesla at its current weight around, let's say 2-3%. Meanwhile, behind the scenes, you begin to unload Tesla. Nobody knows that you're unloading Tesla. So that's a way to use the basket to hide both when you're buying and then when you're selling. Thanks, Joe.
Yeah, that's helpful. And then another question that I'm sure comes up a lot, and I don't know if it's specific to Blue Tractor, and I think it's just the space with these various wrappers. There is an investable universe, and we have a slide on that, but I'd love for either you or Terry to talk about what equities and can you invest in strategies utilizing these wrappers. And I know international equities comes up a lot in conversation, and where does that stand? If you could highlight that a little bit.
Okay, Joe, I'll take that question. Currently, under Blue Tractor's exemptive relief, funds can only trade US domestic equities, along with Canadian, Brazilian and Mexican equities. Obviously, they can do futures contracts, you know, rights, ADRs, etc., but it is basically US domestic at this present time. I should say the other wrappers I alluded to previously have also got that investable universe. The only one that doesn't is the preceding active share structure that doesn't have Canadian, Mexican and Brazilian equities. But thus far, it really is plain vanilla US domestic equities. Blue Tractor has actually filed for an expanded investable universe to include fixed income and foreign equities, i.e. Asian and European equities and derivatives. But the SEC is a very conservative organisation. It takes small steps. So it'll really want a proof of concept first before it allows, you know, new investable universes to come into play. So prove yourself first, and then we'll look at, you know, expanding the universe. Really is the SEC's mindset. So I don't expect to see any movement or any expansion in the investable universe for maybe 2 or 3 years at least. Now, great question. What investment strategies fit within the Blue Tractor wrapper? Well, all of them. Any cap size, any value growth, any ESG, sector, etc. But that's not the case with the other structures. For example, who would consider putting a strategy that contained micro or small cap securities into any other competing wrappers? It would truly be nonsensical. But we would like to think that innovative strategies such as sector rotation, disruptive technologies such as AI, robotics, DNA sequencing, and actively management ESG would find a natural home within the Blue Tractor wrapper because of its transparency and its ability to shield the manager's secret sauce. And I mention ESG specifically because these type of investors want to know that their investments align with their social values on a contemporaneous basis, not on a 3-month lag. So owning the Blue Tractor structure offers that transparency to those discerning type of investors, and along with high net worth and ultra high net worth individuals who like to see what they're exposed to within their portfolios daily.
That's definitely helpful. We've covered a lot on the Shielded wrapper, and I think we have a slide here. And Terry, I don't know if you want to summarize. Really, it seems like 4 key boxes here really makes Blue Tractor stand out before we pivot off to the capital markets and distribution aspects.
Okay, well, we can break it down, and Simon has covered these, but let me just add a little bit more flavour. The Blue Tractor solution is a true turnkey cloud service, and we believe that those who don't adopt the digital technology of today will probably find a scrap heap of tomorrow. And in terms of opacity and transparency, again, as Simon explained, we believe we've found the perfect mix to give the market makers the transparency they want to make orderly and efficient markets, but hide the manager's secret sauce. And make no mistake, when we give the market this transparency, we are giving them information. We are not giving them knowledge that predatory traders require. We protect the secret source. So, and remember, as Einstein said, information is not knowledge. And then, we have, the difference in the creation unit, the transparency. And let me just make another point on that. Because the creation unit also defines the level of transparency the market sees and investors. And there's a simple litmus test for transparency. And that litmus test is quite simple. If I see a security in the creation unit, do I know with 100% certainty that security is in the underlying portfolio? If you can answer yes, transparency exists. Any answer other than yes, transparency doesn't exist. And the Blue Tractor wrapper is the only structure that offers transparency on that basis. And then, you know, Simon talks about heartbeat trades and along with that securities lending, ways to actually improve tax efficiency and add further alpha. And you can only do these things if you have transparency. Some structures, i.e. the active share structure, can't do heartbeat trades because they would be revealing the whole portfolio, defeating the object of the structure itself. The proxy structures would start undermining their objective because once again I would start being able to determine what securities are in the underlying portfolio. Now that doesn't matter to us because as we say, there's nothing in a name. But if the objective of your wrapper is to disguise what securities in your portfolio, then you're undermining the objective. So other structures maybe can do it, but undermine what they're actually trying to achieve.
That's great, and thanks, Terry and Simon. If okay, I'd love to pivot to the capital markets aspect, and bring in John, because John, we've talked about this before. If the market makers aren't on board or the APs aren't, then we don't really have any buy-in. I'd love for you to talk a little bit about just who the market makers are. What are they looking for with these structures? What are they finding?
Okay, Joe, thank you. The market makers are not household names. Some of the bigger ones are Citadel, Virtu, Jane Street, GTS, names you don't hear on the commercials, let's put it that way. They are looking for, the first question they always ask you when they're looking at a portfolio, how do I hedge it? Number one question. If they can hedge it, they can make better markets. They assume they're going to make money. Their assumption is, how do I avoid losing money? And that's the whole hedging capability. And with Blue Tracker, you can see the creation basket. So I know it's in there. I know what I'm looking at. I'm not guessing. I'm not hoping, because we're not in the hope business. So I want to know what's there. One of the things that the market makers do, they can make or break a fund. There's no ifs, ands, about it. But there's an aspect that we haven't covered here, and that market makers are the ones who seed products. So when funds come down to market, the market maker is going to seed it, be it with the obviously the appropriate AP. And APs are just basically all the member firms on Wall Street. So, you can go from Goldman to UBS to Merrill Lynch to Morgan and so forth. They're all APs. So the seeding aspect is, and so basically you're asking the market maker to put up, $5 million, $10 million, $20 million to seed this product. These new products are smaller, so there's only, the creation units are much smaller, 5,000. Clipbridge has 10,000. Fidelity has 25,000 share baskets, which are traditionally they were 50,000. I used to run baskets up to 150,000 shares at a clip. So there was quite a lot of money involved in that. So now you have they do the creation aspect of, they do the seeding, and now we're ready to trade. Okay, they're looking to make two-sided markets. That's what you want the market maker to do. To take down anything and everything that comes in, both buy side, sell side. What they also can do that a lot of people don't know, and it's probably the key here of all, they can short naked. So if someone comes in and they want to buy something, they can sell it to them, even though they don't own the security or they don't do the borrow. That is the lifeblood of this market. They tried to shut that down in 2009, the SEC, and they realized like 5 minutes later they shut all Wall Street down, because if you can't short naked, you can't do anything. So what happens? You have 5 days to cover those. Okay, so if you don't do a creation in that time period or buy it back as an hour's trade basis, you have 5 days to cover, or you'll be bought in. That's one of the key aspects that really kind of makes the market move along here. There's different type of market makers. You have what's called lead market makers, which are kind of quasi-specialists. They're assigned to the specific actual ETFs, and then you have other market makers who just join in. The lead market maker has to make markets in what's called the NBBO, National Best Bid and Offer. So they have a little more responsibility on their plate. The other thing is the actual making of markets is so key in the sense of there's two things. People always talk about tight markets. Well, tight markets is kind of misnomer because you can have a market 20 bid at 20.01, 100 up. Now, what good does that do me, right? It's tight and deep markets. You want some size there. So when someone comes in to buy a particular piece, they can do it and not have to go do 2 or 3 different prices, which will never happen. People will step in. So, like I said, they're kind of the unsung heroes. Like liquidity is like the lifeblood of all markets, and these guys are kind of the engineers, the guys that are actually going to make things happen. And without them, you just go home. It's just not going to work. And I've seen the key. You get good crew of market makers and good OMM. You have a very good chance of having a successful product. You also have to have a good product, obviously, to begin with. But these guys can even I've seen them make mediocre products really good because the markets were tight and they were there, and then just kind of flow begets flow, and volume begets volume, and then you have a successful product. That's kind of
I feel
Joe, what they do,
Yeah, it's something that this could be 2 hours. We could talk about this, and I guess the benefit is if any of and that's the benefit of your guys' group here. I think anybody listening or anybody with those questions could pick up the phone and get you on the line, and you wouldn't get bored of those conversations. You would enjoy really diving in and educating those mutual fund asset managers on what it means and what it really means on the market making and AP side, which is great. And hang tight, John, because I want to come back to you on the distribution side. But before that, talk a little bit about launching, just to highlight a launching the ETF. And Simon, we do a lot of educating at Foreside in terms of what it takes to launch an ETF. We recommend that they talk to their custodians and administrators, their law firms, their auditors, and then you're having those discussions as well. I think the last time we actually physically saw each other before this whole COVID environment shutdown took place was at that New York Stock Exchange ETF Summit, where you guys did a wonderful job really getting up there and describing your structure. I was moderating a piece with the custodians talking about the nuts and bolts of the ETF related to this structure. And it sounds like they're all on board. They're ready to go. They've proven it with a few launches. But what are the other key considerations based on the conversations you're having with those managers about launching an ETF?
Absolutely, Joe. Yeah, no, I remember, of course, the New York Stock Exchange event. You're right. It seemed like so long ago before the virus, of course, took over our existence. But yeah. So, anyways, on to reality here. So you're right. A lot of folks say, "Hey, an ETF. It sounds mysterious because of the E and the T," as I think John said, the exchange and the trading. So yeah, there are certain things to think about that a traditional mutual fund complex has not thought about. And, these bubbles here highlight some of them, and we've touched upon them already today, of course, so far, especially with John on the capital markets side. But let's just go through them one by one. I mean, obviously, your fund strategy is paramount. You got to have a good product. You got to have a good performance. You got to have a good manager. I mean, one thing to think about, this may sound trite, but I mean, all these wrappers, Blue Tractors, et cetera, aren't going to save a bad manager. If you're underperforming now, yeah, we can try and strip away some costs and make you more tax efficient, but if you can't pick stocks, it's not going to work really well, even in these new wrappers. So I think what we're saying at the end of the day is that these wrappers are really designed for your 3, 4, 5-star wrappers, the ones that can be unleashed into this new wrapper structure that takes away costs, makes them more tax efficient, and really lets them perform and show how they can beat their their benchmarks consistently over time. So what kind of strategies are we seeing so far? I mean, we're seeing the obvious clone. You can clone your mutual fund strategy and put that into an ETF wrapper. You can develop a brand new strategy and try and bring that out. Of course, in all these things, unfortunately, what you can't bring with you is your performance, because you can't just say, well, because I did that in a mutual fund for the last 10 years, here's my performance that's inside the ETF. It's the same. Unfortunately, the SEC does not allow that. So what people are trying to do is the holy grail now, which is convert. Can I convert my mutual fund into the ETF on a tax-free basis, and therefore bring the manager's historical trading performance with it as well? A lot of smart lawyers are thinking about that, and we'll see those in the future, but hitherto that's not been available yet to the mutual fund industry. Okay, pricing, that's key too. How am I going to price these things? I mean, let's be honest, ETFs, as we know, there's been a race to the bottom now in pricing in the transparent space. I mean, you can buy a broad index now for almost nothing, 1 basis point. So you're not going to see the same pricing in the ETF lane as you do in mutual fund land. So what we've seen so far is that of the 8 funds that have launched, the pricing ranges from 39 to 59 basis points, okay? Still attractive, yet still not as perhaps robust as a traditional mutual fund have priced in the past. So keep that in mind. John talked a lot about capital markets. That's a key aspect. You're going to have to build that team internally, because you're going to want to talk to the market makers every day and the APs, understand how your product's trading. Is it sloppy? Is it tight? What's going on? What are they hearing? Are there going to be creations and redemptions coming your way? You need to have your ears and the pulse of the market, and that's your capital markets desk. Well, the good news is you can do it yourself, or you can go to specialty firms, trading sub-advisory firms that will happily take on that task for you. I'm thinking of firms like Pensera, Vidant, Exponential. These are firms that can run your money for you. Alps Advisors, for example. All right, distribution is a key, and I know we have a talk about that slide later on with John about that. That's been a big focus now of the market. Well, how do I distribute these products? Because these are secondary market products, i.e. they trade on a stock exchange, either on NYSE, CBOE, or NASDAQ. So people aren't coming to you directly and buying your funds. So if they're not coming to you directly, how do you reach them? How do you market to them? How do you make them want to buy your fund versus somebody else? That's a big component. And again, there's firms that are focused on this that we're happy to tell you about, as well as speak to Foreside. I mean, Joe, that's one of the big things I know Foreside talks about with their clients is how best to distribute these ETFs. So again, I would encourage folks to contact Foreside on that. And then there's a whole administrative angle, compliance, ETF trustees, accounting, legal. And again, you can build that yourself, and a lot of folks do, because, if you're if you've been in the market for a long time in the mutual fund space, you've got a lot of these nuts and bolts already in place. But if you don't, another option is to consider a series trust. These are white label firms that have built the A to Z of all the administrative requirements, and they can allow you to sort of focus on what you do best, picking stocks and running your money, and let them handle all the administrative stuff. So that's another option as well. And finally, the regulatory and legal. It's still a regulated market. The SEC is still part of this. You may have heard about transparent ETFs have got this Rule 6C11 that allows them to quickly go to market and take off some of the administrative burden and the red tape. Unfortunately, these new non- or semi-transparent wrappers don't have that yet. So there will be a requirement to go to the SEC and get your exemptive relief before you can launch a product. Now, the good news is, Blue Tractor included, is that we've designed our regulatory process to be quite streamlined and simple. And I'll talk a bit more about that later on, but suffice to say there is a bit of a regulatory and legal hurdle, but it's determinate, and and you will get through it. And we're happy, of course, to talk more about that, as well as Joe. I'm sure you also are having the same discussions with your clients about all these aspects. So that's sort of like the high-level view of what to think about. Again, it may sound daunting, but once you get into it, it's not that difficult.
Yeah, I would agree. And there's so many there's so many helpful resources that every time we go through the process with one of our clients, every single firm that's out there is just really consultative and helpful from all of the various aspects. But I do want to talk a little bit more about distribution because of how important it is. Thank you for the shout out because we do spend a lot of time. We do realize at Foreside, that's really what our clients want is they really want to understand the distribution landscape. We've introduced you to Sonia Formato, who helps a lot with the wirehouse and the platforms and does a lot of consulting there. And John, you know that space very well. And I think it's safe to say there's the intermediary landscape and there are the platforms. But there's more than that. And we've talked about it separately before than just those wirehouses. I'd love for you to talk about both aspects, on the platform and then also just what it takes to have good distribution.
Well, let me give another shout out to you. In my hand, I have Foreside ETF Intermediary Agreement Matrix, and you have every firm known to mankind here: RIAs, independents, wires, names, contacts. So it's a nice resource. I think we got this from Sonia, as a matter of fact. So that's another service from Foreside. One of the things I did not mention before, and why this is so confusing and people get kind of thrown up by it, you have to print these to the tape. And you want to talk about daunting. You're dealing with people who their whole life tickets were written, and then you have to put something on the tape. It's quite the conversation. So I had hours and hours of trying to get people comfortable putting things on the tape. Classic distribution, as we know it, came from the mutual fund model. And that was the boots on the ground, external wholesalers, internal wholesalers, dinners, events, ball games, so forth and so on. And that was kind of the model, and some firms still have that. But COVID sidelined all of that, did it not? So you don't have those guys out there knocking on the doors anymore. We've seen more and more people using the social media aspect of to get across their message across, so to speak. You need content. You need the social media. You need the traditional media, a la CNBC, Bloomberg, and things of that nature. You need the podcast. You just need a lot of things out there now that people never used before or used effectively before. Now we're seeing some of these younger firms actually do this. This is their whole approach. It's just this. Actually, I think I saw Ed do it from American Century. He did a whole little blast on this as well. There's a couple of things here that are very kind of frustrating for many people when they launch an ETF. Before you can even talk to a wirehouse, which are the four big wirehouses, you have to have probably a minimum of $25 million before they even look at you, right? And then there's also the 3-year requirement. There's the suitability, and 25 might be low. It used to be 25. Some firms are 50 million. So what do? You launch an ETF, and you cannot talk to these guys, so they will not talk to you. Right? They have no time for you. So you have to go to the IRA market, and you have to go to the independent market, the LPLs, the Raymond James, Commonwealths, Edward Jones. These are the people you have to go to, and the RIAs are the key aspect of it. They're part of, in the Schwab, they all credit to Schwab, Fidelity, Pershing, /TD on the other side of the equation. So we see a lot of them. That's their bread and butter, and that's where all the IRAs kind of gravitate to. So that's the market you have to focus on when you launch an ETF. Until you get to that number of 50 million, and you have some time under your belt. Now, there's an interesting phenomenon going on here. If you look down the league tables and the ETFs, you have those top 3 or 4 firms with, trillions of dollars. But you go down the league table into the middle level and the lower level, there's a lot of innovation going on. A lot of these younger firms are coming up with some very, very interesting products, to say the least. And they've raised some in the billions of dollars without using a wire whatsoever. The wires won't even talk to them. So they've gone that route, and they've been quite successful with that. There's now a lot of other younger firms coming in. And they're not racing to zero, by the way. They're not going 2 bips. These are like 75 bips, 60 bips. They're kind of like the Cathy Wood numbers. These same type numbers like that. So there's some interesting movement going on here. So I don't know what will happen with the wires, where when these younger firms are like, okay, we'll go this route. So I think we'll see some change coming on down there. As far as distribution, using the phones, I mean, I was a big proponent of making calls, but making strategic calls. I hate people calling me up all day long, blasting stuff at me. So that's kind of one. Now that you can't go out and talk to anyone, you really have to have some very, very skilled internals on the phones. And those guys can really, they can make some big inroads. Guys and girls who are really good on the phone. So that's kind of where it is, Joe. It's kind of everything has changed. You know what I'm saying? The whole distribution thing is kind of basically turned on its head. And like I said, we're seeing a lot of different delivery methods right now. And once again, thank you for that great matrix you have. I use it all the time. Thanks.
No, our pleasure. And for those listening, they know how to get a hold of us. They know how to get a hold of you. And those are the conversations we really like. We roll up our sleeves to try to help out because it really just benefits everybody. And, it's one of those situations where, John, it is a competitive landscape in the ETF space, but it's also small and very collegial. So I think everybody's working towards the greater good here of how do we make this all a better offering and a better network and seeing everything grow. And that does go down to the distribution side as well. I know you look at probably every fund. If there's a listed ETF out there, I know you probably have a screen up and can analyze it. So what are you seeing with the recent launches? And I think we have a slide here, Beth, on the recent launches with American Century, ClearBridge, and Fidelity. What's your analysis? What are you kind of seeing to date after these are now live in the market?
Yeah, I follow them like second to second, and there's a couple things. I think people are finally starting not to compare them to spiders, which I always lose my mind on. Well, they're not like spiders. I said, yeah, but spiders are 27 years old. These just came out. How are they possibly going to have the same volume? People actually ask me why they not have the same volume. I think there's a couple different views here. The first one that came out was American Century, right in the mass, like 50 VIX, absolute chaos, right? So they caught a break as the VIX is now lightning and closed last night at around 24. So it's come off big time. The vol, and they have a good crew. They have Citadel is their lead market maker. They have a group called Mizuho. This is the Presidian side. They have two different sides, Mizuho, and they have Cantor as the APR. So there's some that's kind of what they're doing on that side. And I think they've raised on that side. They've raised the two American Century Presidian. They've raised about $240 million, I believe. And a lot of that money is coming from it's like bring your own assets. This is the classic example of bring your own assets. So they have they get a lot of help from the mother firm. Markets are decent. They've tightened up. They were like pretty wide. They've come into the 6 cents and 7 cents. They were like 8.10, so they've come in a little bit. The one thing I am fascinated about it is the ClearBridge. There seems to be a disconnect there between listing and distribution. So they have their issues right now. Fido came out in June, and they're doing a decent number. They also have about 55 million in the market. They have 3 different funds. One fund actually goes back to 1987, with the $32 billion in it. That helps a little bit. Right? So they have a lot of that internalization money as well. And then we have the New York, American Century just listed under New York as well. They listed the ESGA and mid-cap. ESG was funded with $65 million. That kind of helps you a little bit, and mid-cap was $5 million. Once again, I think Citadel is making these markets. So you have professional market makers. GTS is doing the FIDO markets. So it's kind of like those seem to be the two. And as far as APs, we're seeing Virtu as well. They stepped into the play. So it's a work in progress. People are kind of getting familiar with them. And like I said, there's days where things just rock, and there's days where things are kind of quiet. But overall, it's been pretty steady. And for what for coming out of that big vol, this is kind of much easier to list things right now at 25 vol, 24 vol. Things a little more calm. And you got a lot of questions, and a lot of people sitting on the sidelines, just waiting to do these work and so forth and so on, and their volume. There's markets, there's professional market makers in there, so you can get stuff done, and they'll go in between the markets as well. MBBO is the key. You have to at least have that, and you can go in between that. So overall, I give I give it a pretty high marks, and there's a lot more to do. We'll see. Like I said, I was in Spiders in '93. So 95 before we really started to take off, and that was kind of a new thing. These are new things, the same thing. Now we have T-Roll coming down the pipe. They should be here any day now. They're also going to have 4, and they're also going to be in the same price level. Simon explained before, 35, 59 to market. I think they're coming in the 50 range. So that kind of seems to be where we've been waiting for a while. And there's other firms in the wings, and we just move forward. Just kind of. It's excellent. No one get the name, Joe, yet. I mean, I think it was mentioned. Debbie did it yesterday at the conference. She didn't want to use the word "and," so non-transparent. We still don't have that one, that catchy word yet. I can't phrase. Everyone's still working on that. That's for sure.
Yeah. One, it's always great to pick your brain on this subject and getting your perspective. So I'll probably be doing so every in the next quarter or two to kind of see get your thoughts. And then I'd like to pivot to back to Simon. So now you're ready to go. We're starting to wrap up our call too. So I want to make sure we can have some time here to talk about. You're ready to go. You want to engage Blue Tractor. What does it look like? What fees should a manager expect? What does that timeline look like?
Sure, I'll go quite quickly here, just because as you say, we're near the end. We've signed up 5 licensees to date. 3 we've announced. You may have heard about Nottingham, Tidal, and Tarosa. We have more coming. So we've kind of honed our system, so to speak, here when we work with a partner, and we designed it to be very clean and simple. There's no upfront cost. Really, this is basically a free call option. You can sign up with Blue Tractor, dip your toes in, and we'll launch when you're ready. So there's no cost fee to do that. When you do launch, it's a simple royalty based on AUM. So we're charging 4 basis points. We also spent a lot of time with you on the capital markets and the distribution, because I think as you can appreciate from today's discussion, Joe, those are 2 areas that are vital for the success of a new ETF product. And as I said, we have resources such as yourself that we can help clients get in touch with. We also have our own internal expertise through John and other sources. So in terms of a timeline to get to market, this goes back to my point about the legal documentation. It's a very simple application with the SEC. It's called a short form application. So basically within 90 to 100 days, you'll have your approval, your notice, and your order to the SEC to launch your product, your Blue Tractor Shielded Alpha product, under your own name, of course. It's all sort of a white label It's branded as you want. Mutual fund company X, Shielded Alpha ETF if they wanted to do that. In concert with that, you of course file your prospectus with the SEC. So within 5 to 6 months, you'll have your approval and you'll have your prospectus cleared. And then you have to go pick an exchange, whether it's NYSE, CBOE, or NASDAQ, and work with them to file a rule change application. It's called the 19B4. So net within 9 to 10 months, you'll have your documentation in place to launch your ETF. And that may sound like a long time, and frankly, okay, it's almost a year, but timelines will shrink as the SEC gets more used to these products. Plus, time will go fast, and we'll use that time to make sure that your distribution strategy and your capital market strategy are just perfect, so that when you do launch, you'll have success. Thanks, Joe.
I agree with that, the timeline, that it also, I think, is comforting too for some of the sophisticated larger asset managers. They need that time, and the fact that they have that buffer to go internally to allow for them to build it is helpful. And then in terms of fees, I have to ask, because it's always asked, what about additional, because you're doing so much and there's other parties, I know with other structures, are there any other additional fees that managers should be aware of?
That's the great thing, Joe, about the Blue Tractor Shielded Alpha wrapper. There are no other fees, zero. Because we're all cloud-based, we built this for you. The workflow is up in the cloud. There's no other software, hardware, operational. It fits right into the way things are done today. This slide points out the fact that one of the other structures, active shares, requires you to engage in APR, the authorized participant representative, between the fund and the AP community, as well as hire a pricing agent to calculate the 1 second VIV. And I think, as Terry pointed out earlier, there's no free lunch. Someone has to get paid for all these things. None of that exists with the Blue Tractor wrapper. So yes, what we say it's going to cost you is what you do pay. That's it. Thanks.
That's helpful. And the last piece, and it's sort of last, but definitely not least, some would argue maybe the most important aspect are the RIAs. Terry, maybe for you, at Foreside, we, of course, have a strong tie to RIAs. We provide compliance services directly. We have a division that does that directly to over 1,000 RIAs that we have as clients. Why should they care about all of this, and what should they know? What do they need to know to benefit them when they're looking to ultimately benefit their end investor and their client?
Great question. I'll break it down into 3 areas. First and foremost, they should recognize that the Blue Tractor Shielded Alpha structure is simply an ETF wrapper that they're totally familiar with. There's no difference to what's been out there since the early 90s. And then recognize the benefits to the investors in terms of lower cost, greater tax efficiencies. And it offers investors access to new and innovative strategies that I detailed earlier in the presentation. But also, from an RIA's perspective, understand the difference in the client experience when their clients actually trade these in the market. And I went through some of this earlier on in the presentation as well. And also key is, Reg BI is here now. And there's a disclosure requirement. And the SEC is taking this very seriously. And they should consider putting these in model portfolios. Okay? That will be a big plus. And definitely, I would recommend they tap into the experience of Foreside and let them ably guide them through the process, because doing it alone is not a good idea.
We appreciate that, and I think that really wraps it up, that we're really coming down to the end here, and this has been extremely helpful. I want to thank all of you guys at Blue Tractor for taking the time, for going through all of this. There was a lot of information. So if you do have any questions, reach out to me, reach out to your Foreside contact or relationship manager, or Simon. Are there ways to find a little bit more about Blue Tractor and other channels?
Yeah, thanks, Joe. Yeah, obviously, send us an email, simon@bluetractorgroup.com. Happy to schedule an introductory call with you, give you a demo of the cloud service. And of course, on your own, dig a little deeper, go to our website, bluetractorgroup.com. Lots of, things to download, to review. If you want to geek out in the weeds, it's all there. Like I said, it's a journey, it's a process. Take your time with your diligence, look at all the wrappers, do your homework, and see which most trap works best for you. Thanks, Joe.
Great. Well, thank you all, and look forward to seeing you all hopefully soon, maybe in 2021, but in person. Thanks, Beth.
Exactly.
Thanks, guys.
Thanks, Beth.
Great, thanks. I'd like to thank everyone, Joe, Simon, John, Terry, and a big thank you to everyone else who listened in. We hope you found this webinar valuable. Again, if you'd like to further discuss this topic or you just have general questions around Foreside, please reach out. So thank you.